watching the latest news from FinancialMirror.tv. Germany has blamed the United States for spawning the global financial crisis with a blind drive for higher profits and said it would now have to accept greater market regulation and give up its financial superpower status. In some of the toughest language since the crisis worsened earlier this month, German Finance Minister Peer Steinbrück told Parliament the financial turmoil would leave deep marks, but this was primarily an American problem. The deputy leader of the centre-left Social Democrats told the Bundestag lower house that the world will never be as it was before the crisis, adding that the world financial system will become more multipolar. Steinbrück, whose efforts for greater transparency on hedge funds during Germany's G8 presidency last year were defeated by Washington and London, attacked what he called an Anglo-Saxon drive for double-digit profits and massive bonuses for bankers and company executives. He proposed an international ban on speculative short selling and an increase in capital requirements for banks in order to offset credit risks. British banks scrambled for funds at the Bank of England's one-week cash auction on Thursday as nerves pushed money markets deeper into gridlock. Banks put in bids worth nearly £90 billion, far exceeding the £53 billion on offer. Strains in money markets have reappeared with a vengeance, and banks want to hoard cash rather than lend it, even refusing to lend to each other for anything longer than overnight, reflecting nervousness as the US financial rescue plans make their way through Congress. The Bank of England acknowledged such tensions by re-offering an additional £5 billion that it first offered last week, but analysts said there was clearly appetite for more. The spread between 3-month sterling LIBOR and the overnight index swap rate rose to a record high of more than 150 basis points on Wednesday. World stock prices were mixed on Thursday. The dollar fell across the board and the cost of borrowing dollars remained high as anxiety over a $700 billion bailout for the US financial system persisted. But even if the bailout is passed, investors were unsure how that would prevent the US economy from slowing further after this month's collapse of Lehman Brothers and the bailout of Fannie Mae, Freddie Mac and the AIG. In early European trading, 3-month interbank dollar deposit rates were indicated at a 4.29 to 5.29% range, at least 225 basis points above the Federal Reserve's benchmark interest rate of 2%. The closely watched TED spread, the difference between market-based dollar rates and 3-month US government borrowing rates, fluctuated in a range of 300 and 420 basis points, less than the 500 basis points last week, the widest in 25 years. Morgan Stanley said that despite unprecedented stresses during the past fortnight, the system's improved ability to withstand shocks may eventually become a source of renewed confidence. The dollar fell 0.6% against a basket of major currencies, while the euro rose 0.7% to the dollar as doubts emerged as to how to finance the rescue package and concerns grew over the economy. US light crude rose by 1/3%, helped by a weaker dollar. Gold rose to $891.65 an ounce. Russia wants to influence global oil prices through output forecasts and mothballing deposits for future development. Its energy minister said Russia's policy would not involve coordinated action with OPEC states, although he said the oil cartel should do its part to smooth the price rollercoaster ride of recent months. Russia, the world's second largest crude exporter, sent a high-level delegation to a September OPEC meeting and has promised to do the same when the cartel meets in December. Falling prices are of particular concern to Russia as its oil companies struggle to keep output growing and the government tries to balance its need for rising production with a policy of heavy taxation on the oil sector. In the wake of a liquidity crisis, the government slashed oil export duties, which lag moves in crude markets and continue to reflect far higher prices to try to return some cash to the industry and free up oil revenue for the economy. Italy's biggest union may back a sweetened investor rescue of Alitalia, spurring hopes the bailout will be salvaged before the bankrupt airline loses its license to fly. Pilots and flight assistants that had bitterly opposed the deal also backed down and called for a members' meeting to review new facts. Unions gathered to hold talks at the Prime Minister's office as Alitalia's bankruptcy commissioner prepared to present a rescue plan to aviation authorities or have the operating licence revoked. The CIGL union is set to back the sale of Alitalia assets to Italian investor group CAI after it agreed to concessions on salaries and jobs. CAI withdrew its offer for Alitalia assets last week after unions cried foul over the deal, but the investor group may return, with Air France-KLM considering a 25% stake in the consortium. Portugal's socialist government is rolling out 500,000 ultra-cheap laptops for school children in a program that could be extended to Venezuela. The computers, called Magellan, after the 16th century Portuguese explorer, will use Intel processors and will be offered to schools at a subsidized price of just €50. The government hopes the Magellan will boost the computer literacy of school children aged from 6 to 11, as the country has some of the lowest school achievement levels in Western Europe. The computer is based on Intel's Classmate PC, a cheap computer that's been adopted in various formats in Brazil and Indonesia. The computers will also go on public sale this week for €285. Watch out, Mary Poppins! The hurricane howling through the world's financial markets is starting to be felt in the rarefied world of the British nanny. As bankers and money dealers fall like flies to a credit crunch, the nannies that they've been employing on salaries of up to £40,000 or $73,000 have suddenly become expensive luxuries. The past 12 to 18 months were a golden era for nannies in London, but in recent months pay rates have started to come down and now the jobs are going too. That's it. Thank you for watching FinancialMirror.tv.